Welcome to Protecting Profits. My name is Steve Chappell, the Director of Trading Systems Development here at VectorVest, and I'm delighted to bring you this presentation. You know, just to kind of set the stage here, this presentation is a result of really many things. But one is that there's been an awful lot of chatter in our daily trading room, you know, the Jockey Club, and I'm also starting to receive a bunch of emails that all kind of center around this. The question is, I'm sitting on a pile of unrealized profits. I've been buying stocks for March of this year and really started to get heavily back into the market back here on October off that market bottom. And boy, you know, these clean energy stocks went on a tear. And how do I make sure that I don't let all of these profits just slip by the wayside? You know, how do I ensure that I can protect what I've already made, realizing that the market is back to all-time highs, you know, and seems to be kind of really struggling at this level right now. What do I do? You know, what are some things that I can do? So let's get to it. First, just to kind of set the stage, I think this is the catalyst for all the chatter. You know, there's a tremendous amount of market uncertainty out there, to be sure. Fiscal stimulus or no fiscal stimulus, I think we all agree some sort of fiscal stimulus is definitely coming our way. But the question is when and how much, and you know, more so those kinds of things. But we've seen even this week how just the chatter on fiscal stimulus can really move markets, you know, from not going to have a deal to, hey, wait a minute, you know, we believe there is going to be a deal in the market, you know, shot right back up off of the lows that was turning out to look like a pretty ugly day, right? And then we're in the midst of earnings season. Some reports have gone very, very, very well. Other reports have been good on the quarter, but the forward guidance wasn't so great. And some reports have gone poorly and everything in between, you know, but I'm going to let the person writing the views go into more detail. I think they're going to have that in mind for tonight and are going to really cover that in the detail that it requires. Okay. But we also have the election cycle. Certainly we're in the thick of that. You know, a lot of wild stuff going on there, you know, and the vaccine, you know, poor Gottlieb, they bring him on CNBC every morning and he's got to talk about, you know, any kind of new development. What does this mean? And, you know, when is it coming? And, you know, oh my goodness, right? But all of this is really, I think, in investors' minds, creating some challenges. And I'm here to deliver you one main message before I get to the 8 techniques. And that is trust your indicators. You know, you have the most powerful software product on the stock market at your fingertips. And one of those reasons, there are many, but one of them is the indicators that are in there to help you guide, you know, survive and actually profit through turbulent times. And so let's get over to it and show you what we mean. There are some warning signs that have begun to resonate this week. Now, those are going to be setting us up for things to look out for in the near future. Okay, but I want to point some of those things out first, then we'll talk about, you know, when do I want to deploy some of the tactics we'll talk about later. So a couple of things. One, markets are up today. We're one tick into the green, you know, and we're saying here that VectorVest advocates buying stocks that are rising in price this time. All right, so great. I mean, markets are up and absolutely looks like the appropriate thing to be doing. When we come down to the color guard, this is where things get a little bit more interesting. So the current price is 52.66, right? When we look back a week ago, it was 52.41. That's for today, right? So we're higher week over week and day over day. Naturally, we're green. And since we're higher week over week, the primary wave is up. Okay. When we get to Monday, in order for the primary wave to remain up, it'll have to close on Monday above 52.84. Okay, so it's got a little work to do between now and the close Monday to hang on to the primary up wave. Remember, that's week over week, okay? It gets a little bit easier Tuesday if it's able to maintain that, and so on and so forth. But Monday can be kind of a pivotal day because rule number one is don't buy stocks when the primary wave is down. So at the very least, one really good tactic to deal with the current situation is if the primary wave is down next week, don't buy stocks. Don't replace. So if you sell something, just keep getting some more powder dry. Don't go out there buying stocks if the market is not moving higher on a week-over-week basis. That is a main observation to make. A couple more here that we can kind of try to lean on, and that is when we look at the relative timing and the buy-to-sell ratio columns, both of them are substantially lower still on a week-over-week basis. So we're losing some strength here with these indicators. Now the buy-to-sell ratio is up pretty nicely today actually, and it's improved throughout the day because it was coming in level in the early portions of trading today at 1.11. So that's good. I mean, that's encouraging, but we are still well off a week ago's reading, at least at this stage. So when will you feel better about it? When you start to get to higher readings than where we were. This is a good start. However, when we get to the MTI column, potentially the most important, as it's our master indicator, right? It's still continuing to leak. In fact, it's back level again, but just prior to this video, it was at 1.33. Okay, and so that's also a thing that we like to look for here at VectorVest as a warning. And that is when markets are higher and the MTI is lower, it's letting you know that even though the markets are higher today, the underlying trend is dissipating even still. So it's great that we're having a pretty good rally today, right? But overall, things have begun to slow down. It's still strong, so there's more to like here than not like, guys, but these are some warning signs and some observations to make that can serve as alerts for what might unfold next week, okay? So let's talk more about next week. The first thing to look out for next week, we already mentioned, primary wave on Monday, because that's when you stop buying stocks, right? When do I become increasingly more defensive? Well, if the relative timing and the buy-to-sell ratio start to get back below 1, I would. Buy-to-sell ratio in particular, it has yet to make its way below 1. When it does, you no longer have strength to this market rally. You actually are on weakness. You need to see this indicator continue to click up and look like we got some life back in this market before I'd feel really good about buying stocks again. When we look at the MTI, here again, continuing to weaken throughout the course of the week. And this is our master indicator for timing the market, right? So the underlying trend is continuing to dissipate. The strength is dissipating even after today's action, which has kind of been all over the map, but mostly pretty high numbers. It's interesting to make the observation here that the MTI is continuing to weaken. So, just a real quick check on the charts because I've got to get into the techniques. But a lot of you are visual, and I'm really trying to set the stage here. So here's the issue, I think, for a lot of folks, and rightly so. Markets are pivoting up and down in this area of, well, what was resistance that became support is now resistance again, to be quite honest. So it's a battleground, and as we go back, where is that battleground taking place? At all-time highs, at least on the VectorVest composite. You get the point. I mean, this is kind of that pivotal area of, do we have enough evidence that the market is in a place where we can go to new all-time highs, and the answer to that question, of course, is nobody really knows in terms of how's the market going to react to this until it starts to actually do something, and so long story short, on Monday, primary wave turns down, you stop buying stocks. Again, you're going to keep your eye on the buy-to-sell ratio. If it starts to go below 1, you get more defensive, okay? MTI goes below 1, you get even more defensive, so on, etc. However, if the market doesn't go down and goes up and you start to get towards new highs, you start to break some of these high water marks from the first attempt at breakout, then you feel really pretty good about things. I mean, this market has been resilient here and is trying to plow higher and likely will, okay? So those would be the two main things to keep an eye on. Can we break to new highs? Then I think, you're back into more of a safe haven, if you will, about buying stocks again, at least more so than you are right now. And if we fall for a day or two, you're going to be more strongly leaning towards getting more and more defensive, right? So let's go and take a look at how to become defensive. What are some great tactics that I can deploy? Well, all of them have been supplied to us by our founder, Dr. Bart DeLito. And the first thing is to use protective stop loss orders. Dr. DeLito discusses this at pretty good length in Chapter 10 of Stock Strategies and Common Sense. And technically oriented investors, they may prefer to use something like a moving average to help them decide when to sell a stock. So a couple of things here really quick. If I go over to VectorVest, one thing is on the welcome page, you have the ability to download that book. You could go to Chapter 10 and do some reading in that regard. Okay. The other thing is just chasing that idea that we just learned about, using moving averages. Let's just do, this is a stock that we've been having some fun with in our swing trading coaching. Okay. So here's Jazz. Jazz has made some good move right up the page, kind of stock you want to buy. And lo and behold, it's been in such a good move that it's got some space, between price and the moving average. And so, if we just ended up buying the stock, let's say as it really started to heat up, I may not want to see this come all the way down to the 40-day moving average and just, see what's been a reasonably good profitable trade, majority of it slip away. So what can we do? We can tighten that moving average even, guys. So one that's working really well, for example, is like a 20. And what I'm doing is I'm just trying to custom fit this average to incorporate a lot of the troughs, okay? And so this stock really likes to find support at that 20 average. So the expectation would be if it's going to stop going down and start going up again in the future, odds are it's going to be right around that moving average. But what we've done is we've at least locked in more profit potential by elevating that moving average. And 20 tends to be a moving average that a lot of the more well-known, heavily traded securities tend to abide by pretty darn well. Okay, so there's just some good simple guidance in that. All right, now, number 2, we can sell covered calls. When you sell a call option while owning a stock, you're writing what's called a covered call. Okay, if the stock price rises, you may be forced to sell the stock at the strike price you select, and that's known as being called away. If the stock price continues to drop, you can sell calls against the stock position over and over and over again. Your losses on the stock position will be at least partially offset by all the premiums you will put in your pocket. So for folks that are sitting on stocks that have tremendous gains over the years and you don't want to sell those stocks for tax purposes or whatever the case may be, this is a great option. And we'll spend a lot more time talking about this option in a lot of the options education that we teach. And so options Jumpstarter and on down the line, but options Jumpstarter kind of being the best place to start. It's up there in our digital library and would be tremendous. We truly believe everybody should at least learn the option basics. And for this reason right here, selling covered call options, you can hardly go wrong, to tell you the truth. But you'll learn more about that if you decide to take us up on that course. Number 3, buy put options. Listen, put options are a great alternative here as well. If you own a stock, you profit when the stock price rises, right? If you own a put option, you profit if the stock price drops or falls, okay? So if you buy a put option while also owning a stock, you're basically buying an insurance policy. So if the stock price drops, the put will rise in value, offsetting some of the loss on the stock. If the stock rises, the put will decrease in value, perhaps expiring worthless, just as an insurance policy is designed to do. Of course, you must take money out of your pocket to pay the premium. So with the call option, we were collecting premium to offset loss. With the put option, you get a little bit more of a security blanket, but you got to pay for that protection out of pocket. And that's what a lot of folks struggle with. I know I should buy a put option, but do I really want to spend this much? It might become worthless. Well, enter the collar. So this would be combining methods 2 and 3, selling a call and also buying a put at the same time. So selling a higher price call, buying a lower price put. Okay. This is a terrific way to finance your insurance policy, is to do both. This is more commonly known as a collar option. We outlined this technique in some detail on March 2003 and more recently on June 12, 2009 in the VectorVest views. So you can go back and read up on that a little bit more. But this is what a lot of the hedge funds, big money managers will do even over the course of a weekend, with those real substantial billion-dollar portfolios. A lot can happen over the course of a weekend to change the landscape of things, So collars actually have a little bit of upside to them typically, but have a substantial amount of protection to the downside as well. So it's a great money management tactic and one worth learning, again, if you start to get a little deeper into our options curriculum. Okay. Number 5, buy index put options. You might be like many of us who often have maybe 20 positions in the stock market. And so going out there and buying, a put option against every single one, well, they all have an expense and it's a lot to do and a lot to manage and a lot to take care of. So this is a great tactic. If you own many stocks in your portfolio from a particular market segment, such as say the NASDAQ, you could simply buy Q's put options on the index instead of each individual stock. If the index drops, the put options will increase in value as the prices of the stocks are dropping. This is the same idea as method 3 above, but you would use the index put options instead of individual puts on each stock, which is awesome. One singular trade can offset the balance of your portfolio if you construct the appropriate number of shares to do that offset. All right, cool. So let me go ahead and we can hedge with short sales and we can buy Contra ETFs as a hedge. This is something that I have done this week. This very same thing, number 6, okay? We have several searches located in the ETFs folder in Unisearch, which will guide you to the funds best poised to profit when market contracts. If you want to avoid the leveraged funds, you can simply choose from the non-leveraged ETFs Contra. There's a watch list for that, okay? And look for funds with more of a 1-to-1 ratio. So I do want to do a little bit of education here to be sure. I'm going to go into Unisearch. Quickly in Unisearch, if you go to the folder view, we're going to have an ETFs folder. In there, you'll find things like buying Contra ETFs. Okay, so if you run the search, it'll produce a list of things. And these are ones to choose from. Anything that says 3 times, that's 3-time leveraged. So for the market that it represents, if it falls, you get 3 points reward for every point of fall, which is really good when markets are falling. But if it goes the other way, if the markets actually turn up, then you lose 3 points. So there's a give and a take with leverage. And you're going to find an awful lot of leveraged as the top performers in these searches. And so what we're pointing out in that text is this is really great if you're more of a trader or have some experience with inverse funds already and kind of know the benefits and the consequences. Because these can really, I can buy 1/3 of the amount of Contras to offset my portfolio if I do it right, But if, you don't understand these kinds of concepts yet, what you want to do is come over to Viewers. In Viewers, I'm going to go to Watch List Viewer, ETFs folder again, and you'll have different leverage breakouts. You'll have 2 times, 3 times. I've done prior videos where I showed the benefit of going 2 times, It gives you a really substantial reward, and it's not as all over the place as 3-time funds can be on a day-to-day basis. So there's different breakouts here. If we slide down, I'm going to take you to this one. Non-leveraged ETFs Contra. This is where you want to live if you like the idea but don't want to take the risk of the leverage, which probably is most folks, okay? Now, when you get in here, what you want to do is not necessarily just start digging from the top like you normally would do in, say, Stock Viewer. What you want to do is come out here to the right and sort by volume. That's going to do a really nice thing for you. It's going to give you plenty of liquidity. It's going to do two nice things. You get the liquidity, but you also get broad market funds. So you got S&P 5, the Qs or NASDAQ, the Russell, the Dow right at the top. These are the four. These are broad market. You're not getting off into, treasuries or market sectors or anything like that where you can get in a bit of trouble if you're not careful. So these would be the ones, okay? And if the market falls, they will offset 1-to-1 on those markets that they represent. So if you don't get things right, these won't hurt you very much. They do a really nice job of offset and don't get you into hot water if you're not careful. All right, great. So with that, let's go back, finish her up. We can hedge with short sales. Now, this is one that I don't think a lot of folks do, but it is possible. We've got some great shorting searches in VectorVest. I mean, worst stocks over $20 has always been my favorite. It's just a great search. It looks for stocks that are already doing what you want them to do when you short them, and that's go down, But this is another way. It's another way to protect profits in an uncertain market. You can sell short bad stocks. That's the key. You don't want to sell short Microsoft or Google or Jinko Solar, God forbid, right now in particular. That thing has gone up, 300% in the last 2 weeks? You don't want to do that. What you want to do is find the stocks that are going down and short those. Okay, so for example, you might use the search and short group in VectorVest to find those stocks that are likely to go down and sell them short. If the market falls, the shorts will rise in value while offsetting the losses you might incur in your core holdings. Stocks fall faster than they rise, so they typically do a good job of this. It's just not something that as many folks are seemingly as apt to do as other things on the list, but it's an option. And then finally, 8, sell the stocks outright. This is always a great one if you're really not sure what you want to do, because if you're really not sure what you want to do, odds are this is the right candidate. The surest way to protect your unrealized stock profits is to simply sell the stocks you have. You would then simply hold in the cash position in your account while waiting for the market to settle down. Of course, once the stocks are sold, you can't participate in any further upside price moves. That's the detriment if that turns out to be the case. But also, unless you're selling the stocks in some sort of tax advantage account, such as an IRA, you're going to owe tax on your capital gains. And so that's a sticky point to think about in terms of what you're going to do. That's why huge fan of options, 2, 3, 4 even, with selling calls, buying puts, doing the collar. Those help you avoid this kind of a situation if it really is something that needs to be avoided for you. Okay. All right. So those are the different ways, and I hope you enjoyed this presentation. Next week is a pivotal week, guys. I mean, we've kind of laid it out there for you, things to be on the lookout for. First things first, primary wave, does it hold? Does it hold in an up mode as we go throughout the week? Number 2, buy to sell ratio, to be sure. Can it stay afloat? Can it stay above 1 and not fall below? Because if you haven't become super defensive in advance of that, that's the time to become super defensive. Okay, always has been, right? Just go back and look at a VectorVest composite chart. Just go back and look at a timing chart. It'll tell you all you need to know. And then finally, as we start to move more towards a DEW down or a confirmed down call, all those are things that are going to help you become more and more increasingly defensive as you need to be. So hopefully this has done a good job at letting you know all I got to do is trust my indicators. All I got to do is trust my indicators, and now I have some tools, right, that I can take advantage of to mitigate against losing all these unrealized profits that I've been able to accumulate for the better part of this year. All right, guys, thanks for tuning in this week. We'll see you again here next week at VectorVest University. See you then.
Bye.